Hello, and thanks for joining us for our quarterly investment perspective review. I'm Aldo Vultaggio, Chief Investment Officer at Capstone Financial Advisors. The following is general commentary on the markets and economy and his opinion. First, a quick market review. The U.S. stock market outperformed in 2024, driven by solid corporate earnings, moderating inflation, and excitement around AI-driven innovation. Meanwhile, international markets struggled due to weaker growth in Europe and China, geopolitical tensions, an appreciating U.S. dollar, and uncertainty around future U.S. trade policy. Shifting to bonds, the story was reversed. International bonds outperformed, benefiting from rate cuts abroad and declining inflation. In the U.S., while higher starting yields provided income, rising long-term rates lowered bond prices and offset much of the income, weighing on overall returns. Stock markets entered 2025 with cautious optimism. U.S. stocks are supported by a resilient economy, strong corporate earnings, and AI-driven innovation. While elevated valuations and trade uncertainties could spark volatility, steady economic growth and favorable policies may drive positive returns. Internationally, central bank easing could help mitigate challenges like uneven growth and trade uncertainty. Combined with deeply discounted valuations, international stocks are poised for a stronger year. Turning to bonds, the U.S. bond market enters 2025 with even higher starting yields than last year, offering significant opportunities for income generation. Internationally, easing inflation and further central bank rate cuts are set to bolster bond values. On the economic front, the U.S. maintained a strong growth rate in 2024, with GDP growth exceeding expectations despite earlier concerns of a slowdown. Consumer spending was a key driver, supported by a strong labor market and rising wages. Inflation cooled, prompting the Fed to lower rates in September, though by year-end they signaled fewer cuts ahead. Abroad, economies faced uneven conditions in 2024. Europe struggled with subdued growth and manufacturing headwinds, but inflation moderated and monetary easing provided a foundation for recovery. Asia presented a mixed outlook, with China's growth hindered by property sector weakness, while Southeast Asia showed resilience driven by strong consumer demand. The U.S. economy is poised for steady growth in 2025, with GDP projected between 2 and 2.5%. Consumer spending and business investment are expected to drive momentum, while inflation gradually declines but remains slightly above the Fed's 2% target. Potential policy shifts under the new administration, which we'll discuss more about later, introduce uncertainty around inflation, likely prompting the Fed to slow the pace of rate cuts. Abroad, economic growth will likely vary widely across regions. Europe faces subdued growth, though monetary easing offers some support. In Asia, China's economy may rely on additional fiscal stimulus to address slowing demand and trade pressures, while Japan and Southeast Asia could benefit from resilient consumer spending and shifts in global supply chains. With a new administration in place, shifts in economic policy are likely on the horizon. Proposals such as corporate tax cuts, spending reductions, and changes to trade and immigration policy aim to stimulate growth and boost U.S. competitiveness. While these initiatives hold potential, markets remain cautious amid uncertainties around their implementation and potential impacts. U.S. policy uncertainty spiked after the election and reached its highest level since the onset of the COVID pandemic in 2019. Tax cuts are a central focus, including extending the Tax Cuts and Jobs Act and potentially lowering the corporate tax rate from 20% to 15%. Such changes could bolster corporate profitability and spur domestic investment in manufacturing and technology. However, budgetary constraints and slim Republican majorities in Congress could limit these reforms, with any additional tax cuts likely to be limited. Proposed government spending cuts, targeting reductions of up to 10 to 15%, also face challenges. Political resistance and the need to fund priorities like defense and entitlement programs make sweeping cuts unlikely, with limited broader economic impact expected. Similarly, trade policy proposals, including new tariffs on imports from China, could raise consumer prices and strain trade relations. Most tariffs, however, are likely to remain modest and primarily serve as negotiation tools. On immigration, efforts to limit workforce inflows could tighten the labor market and increase wage pressures. Though these changes are expected to be gradual and have only marginal effects on inflation and growth. Net immigration is likely to decline somewhat, but we don't anticipate drastic reductions. Despite these uncertainties, the outlook remains cautiously optimistic. Thoughtful implementation of these policies could foster corporate earnings growth and support the economy. Legislative hurdles and missteps may temper their impact, but the U.S. economy's long-term growth trajectory is unlikely to change significantly. Our portfolio positioning is guided by current market and economic conditions, balanced with a long-term investment perspective. While higher bond yields and potential further stock market gains present opportunities, risks such as above-target inflation and elevated U.S. stock market valuations remind us of the importance of proactive portfolio management. Stock market rallies like we've seen over the past 2 years offer a chance to rebalance portfolios. By trimming higher price assets like U.S. stocks and reallocating to undervalued areas such as bonds and international stocks, we keep portfolios aligned with strategic targets. Rebalancing not only helps manage risk, but also improves risk-adjusted returns over time. Within stock allocations, we recommend maintaining broad diversification across sectors, styles, and regions. Concentrating too heavily in a few high-performing stocks, such as U.S. mega-cap tech stocks, can expose portfolios to unnecessary risk. Diversifying allows investors to better capture future market gains as performance broadens across sectors and geographies. In the bond market, we see opportunities in high-quality intermediate-term bonds. These investments provide attractive yields and act as a buffer during economic slowdowns. With the Federal Reserve continuing to lower rates, short-term yields are expected to decline, making intermediate-term bonds even more compelling for income generation and stability. Finally, we encourage investors to consider additional diversification through private markets. For clients who meet certain requirements and can tolerate some illiquidity, private equity, private credit, and private real assets offer opportunities for higher returns, lower correlations, and unique investments not available in public markets. These strategies complement public market holdings and align with our philosophy of building resilient long-term portfolios. If you found this information helpful, please click like. Click the subscribe button to be notified of future videos. Thanks for watching.